You have seen it in your mailbox, in the Sunday paper, tucked under windshield wipers in parking lots, a small blue rectangle with a black border carrying a simple promise, 20% off any single item. For millions of American families, that coupon was a ritual. You saved it for something big: a KitchenAid stand mixer, a set of Egyptian cotton sheets, a duvet that cost more than you planned to spend but somehow felt reasonable because of that small blue rectangle in your hand. Bed Bath & Beyond built an empire on that coupon, and then it destroyed itself trying to get rid of it. This is the story of how a company that was once worth $17 billion, a company that had survived the rise of Amazon, the collapse of retail chains around it, and the Great Recession, managed to spend $11.8 billion on its own stock while its stores ran out of merchandise, its customers walked out empty-handed, and its leadership made a series of decisions so misaligned with the company's own identity that analysts are still studying them as a case study in what not to do. By April 2023, it was over. Chapter 11: Bankruptcy, Store Closures. 5 decades of American retail history gone. This is the complete story of the rise and fall of Bed Bath & Beyond. The story begins in 1971 in Springfield, New Jersey, with 2 men who had spent years working at a discount retail chain called Arlen's and had come to a simple conclusion: niche stores that served customers better in a specific category would outperform general discount stores that tried to serve everyone. Leonard Feinstein and Warren Eisenberg were not visionaries in the technology disruption sense. They were merchants, men who understood inventory, customer behavior, and the psychology of retail. Their insight was that the American consumer in the early 1970s wanted a store that was specifically and deeply stocked in household linens and bath accessories. Not a department store with a linen section, a store where the entire experience was linens and bath, where selection was overwhelming, prices were competitive, and customers felt like they were getting access to a specialist rather than a generalist. They called it Bed & Bath. The first store was small. The ambitions were larger. The 1980s were a golden era for this model. Consumer spending was rising. Suburban America was expanding. The concept of the category killer, a big box retailer that dominated a single product category, was proving itself across multiple industries. Home Depot was doing it in hardware, Circuit City was doing it in electronics, Toys R Us was doing it in children's products. Bed Bath & Beyond, renamed in 1987 when it added the Beyond to signal an expansion beyond linens into housewares and gifts, was doing it in home goods. In 1992, the company went public on the NASDAQ. The IPO was a success. The store count was growing, the brand was becoming national, and the formula, an overwhelming selection of household goods, aggressive pricing, and that coupon, was working in a way that seemed almost unfailingly reliable. Through the 1990s and into the 2000s, Bed Bath & Beyond was a retail success story that analysts used as a model. The company expanded aggressively, eventually operating more than 1,500 stores across the United States and Canada under multiple banners. The flagship Bed Bath & Beyond stores were the anchor. But the company also operated Bye Bye Baby, a specialty baby products chain that would later become one of its most valuable assets. It operated World Market stores. It acquired and expanded multiple retail concepts. At its peak, the company was generating over $12 billion in annual revenue. Its market capitalization reached $17 billion. Wall Street loved it, consumers loved it, and the management team, led for years by co-founders Eisenberg and Feinstein, operating on a model of extreme decentralization that gave individual store managers significant control over their own inventory, maintained a culture of frugality and operational discipline that kept margins healthy. The coupon was the engine, it drove traffic, it created urgency. It gave customers a reason to come in on a specific trip rather than browsing aimlessly, and it subsidized a pricing model that allowed the company to charge standard prices while making customers feel they were getting a deal. The problems at Bed Bath & Beyond did not begin with the 2023 bankruptcy filing. They began a decade earlier, slowly, in ways that were easy to explain away at the time. Amazon was the obvious threat, but Bed Bath & Beyond, unlike many of its retail peers, initially seemed to manage the Amazon transition reasonably well. It invested in its e-commerce platform. It offered online ordering with in-store pickup. It maintained physical presence at a time when the tactile experience of buying bedding, towels, and kitchen equipment still drove a meaningful portion of consumer behavior. But a more insidious problem was building beneath the surface: stock buybacks. Between 2004 and 2023, Bed Bath & Beyond spent $11.8 billion repurchasing its own shares. $11.8 billion. To put that number in context, it is more than twice the total debt the company carried on its books at the time of its bankruptcy filing. It is more money than the company earned in net profit over most of its existence. It is an extraordinary sum to direct away from operations, inventory, store renovation, and technology investment. Stock buybacks are a common corporate practice. They signal confidence in the company's own value. They return capital to shareholders. They support the stock price. But they only make sense when a company has sufficient cash flow, a strong balance sheet, and no better use for the capital. At Bed Bath & Beyond, the buyback program continued even as the underlying business was showing signs of structural stress, even as Amazon was taking market share, even as store traffic was declining, even as the competitive landscape was shifting in ways that demanded investment, not extraction. By the time the board recognized that fundamental change was needed, the company had spent a decade directing capital away from the very investments that could have funded a real transformation. In late 2019, Bed Bath & Beyond hired a new CEO, Mark Tritton, a veteran of Target and Nordstrom who had built a reputation as one of the most skilled merchants in American retail. At Target, Tritton had overseen the launch of more than 30 new private label brands, owned brands developed exclusively for Target that competed with national brands on quality while delivering higher margins. Several of those brands became billion-dollar franchises. Target's private label strategy under Tritton was widely praised as one of the most successful brand-building initiatives in modern retail. The board of Bed Bath & Beyond looked at Tritton and saw exactly what they wanted: a proven merchant who had already transformed a struggling retailer using a strategy they could understand and model. The strategy he brought to Bed Bath & Beyond was a carbon copy of what he had done at Target: aggressively develop private labels, reduce dependence on national brands, pull back on the coupon to protect margins, modernize the store experience, and close underperforming locations. On paper, it made sense. In execution, it was catastrophic. The problem was that Bed Bath & Beyond was not Target. Target's private labels worked because Target had a broad, diverse customer base that came to its stores for groceries, clothing, electronics, and home goods. The private label brands could earn loyalty across multiple categories because the shopper was already in the store for dozens of reasons. Bed Bath & Beyond's customers came for one reason: household goods. And they came with brand loyalty that was almost entirely directed at the national brands those customers knew and trusted: KitchenAid, Cuisinart, Dyson, Le Creuset. The customer who wanted a stand mixer wanted the KitchenAid, not a Bed Bath & Beyond-owned brand called Haven or Nestwell that they had never heard of and had no reason to trust. Tritton's team removed the national brands from shelves to make room for the private labels. Sales fell sharply. Customers who came in looking for the products they trusted found unfamiliar alternatives and left. Some of them never came back. Making matters significantly worse, the private label strategy required a complete overhaul of the company's supply chain, a process that created severe inventory disruptions during the critical holiday seasons of 2021 and 2022. In the fourth quarter of 2021, the company estimated approximately $175 million in lost sales due to out-of-stock merchandise. Customers came in, the shelves were empty, they walked out. While Bed Bath & Beyond's operational reality was deteriorating, something strange was happening to its stock. In early 2021, in the immediate aftermath of the GameStop short squeeze that briefly turned retail investors into a market force capable of moving hedge funds, Bed Bath & Beyond found itself caught in the orbit of meme stock mania. Its heavily shorted stock was attractive to the online retail trading community. That the stock, which had been trading at a few dollars a share, surged dramatically. At the peak of the first meme stock wave, Bed Bath & Beyond's market capitalization briefly reached $6.4 billion, a valuation almost entirely disconnected from any rational assessment of the company's operational performance. In March 2022, things got more complicated. Ryan Cohen, the co-founder of Chewy, the online pet products company, and the chairman of GameStop, disclosed through his investment vehicle RC Ventures that he had acquired a nearly 10% stake in Bed Bath & Beyond. Cohen published a letter to the board criticizing Mark Tritton's strategy and calling for the company to sell or spin off Bye Bye Baby and potentially sell the entire company. He pushed for and won 3 board seats. The market treated this as a signal that Cohen would do for Bed Bath & Beyond what he had done for GameStop. Then in August 2022, Cohen sold his entire stake, 9.5 million shares, at the height of a stock rally that his public presence had helped fuel. He walked away with an estimated profit of approximately $68 million. The stock plummeted 41% in a single day after his exit was disclosed. Bed Bath & Beyond issued a statement saying it appreciates the opportunity of working with RC Ventures. Mark Tritton was fired in June 2022 after 4 quarters of collapsing sales and compounding operational failures. An independent director named Sue Gove stepped in as interim CEO, tasked with stabilizing a company that was now visibly in freefall. By the end of 2022, Bed Bath & Beyond had more than $1 billion in debt and losses. Closed at $1.30 on January 6, 2023, the lowest since the early 1990s. The company publicly raised doubts about its ability to continue as a going concern. Suppliers, the vendors who had been shipping merchandise to Bed Bath & Beyond stores on credit, began tightening their terms or stopping shipments entirely. Shelves grew emptier. Customers who still wanted to shop there found stores that looked increasingly abandoned. The company attempted emergency capital raises. A February 2023 equity offering intended to raise over $1 billion by selling new shares failed to generate nearly that amount. By April 2023, it had raised only about $48.5 million because the company's declining stock price made the shares nearly worthless as a fundraising instrument. On April 23, 2023, Bed Bath & Beyond filed for Chapter 11 bankruptcy protection in the United States Bankruptcy Court for the District of New Jersey. The filing listed $4.4 billion in assets against $5.2 billion in debt. The company announced the closure of all remaining stores. Bye Bye Baby, which the company had long considered its most valuable asset, and which had been the subject of multiple attempted spin-off plans, was included in the liquidation. The brand name itself, Bed Bath & Beyond, was subsequently acquired by Overstock.com, which rebranded itself using the Bed Bath & Beyond name as a purely digital retailer. But the physical stores were gone. The employees, tens of thousands of them, were gone. The 5-decade story of the Big Blue Coupon was over. The collapse of Bed Bath & Beyond is not a simple story. It is not just about Amazon or just about bad management or just about the coupon or just about the share buybacks. It is about all of those things converging at once. The first lesson is about capital allocation. $11.8 billion in share buybacks over 2 decades, during a period when the business needed that capital for e-commerce investment, supply chain modernization, and the physical renovation of its stores, was a fundamental strategic error. It prioritized short-term shareholder returns over the long-term health of the business. A company cannot spend its way to irrelevance and then blame the competition for catching up. The second lesson is about knowing your customer. The decision to replace trusted national brands with unknown private labels without understanding why customers were loyal to those brands in the first place is a case study in strategy divorced from customer insight. Mark Tritton's playbook worked at Target because Target had a fundamentally different relationship with its customers. Importing that playbook to a company with a different identity, without first understanding what made that identity worth preserving, was a misreading of the situation that cost billions. The third lesson is about the coupon. The 20% coupon was not just a discount, it was the brand. It was the emotional relationship between the company and its customers. It was the reason people came back. When the coupon was curtailed to protect margins, the company did not just lose a promotion, it severed the emotional connection that justified the visit. And once that connection is broken, it is very hard to rebuild. The fourth lesson is about meme stocks and the illusion of rescue. When Ryan Cohen disclosed his stake in early 2022, the market briefly treated it as salvation. It was not. The artificial inflation of a company's stock price by retail trading momentum does not change the operational reality of the business. It only delays the reckoning, and in Bed Bath & Beyond's case, it encouraged decisions like accelerated equity offerings at unsustainable valuations that made the ultimate collapse worse. Bed Bath & Beyond did not die because of bad luck. It died because of decisions made over years by multiple management teams with the best intentions and the worst outcomes. That is the most important lesson of all. And that is the complete story of Bed Bath & Beyond, from two merchants in New Jersey with a small linen store and a big idea, to a $17 billion retail empire, to a Chapter 11 filing and the closure of every single store. The coupon is gone, the stores are gone. The name lives on as a digital brand, a ghost of what was one of the most recognizable retail experiences in American life. If you had that blue coupon in your wallet right now, what would you spend it on? Let us know in the comments. And if you want more of the great collapse stories in American business, we are covering the fall of Sears, the collapse of Blockbuster, and the rise and implosion of WeWork, all coming on the From Billions to Broke playlist here on Legacy Vault. Subscribe and hit the bell so you do not miss a single one. See you in the next video.